and welcome. It's time for the monthly economic briefing presented by the Kenan Institute of Private Enterprise at UNC Kenan-Flagler Business School. I'm External Affairs Interim Director Rob Knapp, and it's great to be with you this morning. So, stop me if you've heard this before, another big jobs number. 303,000 jobs added, according to the report that's just come out this morning. We are going to have Professor Greg Brown along to talk about this, not just the number, but the question that follows that. Things have been going pretty well lately. We continue to add jobs. Inflation is going down. When things go well, the next question is, how do we keep them going well, and what might potentially knock things off track? Greg's going to be along in a moment to talk about that. First of all, we'll give you the rules of the road. Our show will be 30 minutes as usual. Greg will talk for the first half of that, maybe a little longer. There's a lot to talk about today. After that, we invite you to submit your questions. In fact, you can start submitting those now if you want to. You can do that by using the Q&A function at the bottom of your screen. If you're with the media, please let us know as part of your question. Give us your organization so that we can make sure that your question gets asked. If you're with us by phone today, you can submit your question to me by email. I'm at rob_knapp@kenan-flagler.unc.edu. As I said, we'll probably go till 9:30, maybe a touch longer. So get those questions in. If they come too close to the end of the program, we may not be able to get them in this time. So without any further ado, let's move on to a man of many titles. Greg Brown is former executive director at the Kenan Institute. He is a research fellow at the Kenan Institute. He is a finance professor at UNC Kenan-Flagler Business School and many more things, but we've only got 30 minutes. So we will move straight over to him. Good morning, Greg. Good to see you this morning.
Hey, Rob. Thank you. And good morning, everybody. Another exciting employment report for sure. Sort of looking at the detail in the report, it's hard to find much negative about it. I'm going to go ahead and share my screen and show you our slide deck for today. So hopefully you all can see that now. So the headline payrolls number came in quite strong, and some of that was government jobs, but if you look at just the private jobs, also quite strong. The February number was revised down just a tad, but January was revised up. So overall revisions to payrolls were also positive. Sort of expected gains in average hourly earnings of 0.3%. The average weekly hours ticked up to 34.4. Unemployment rate came in as expected at 3.8%, which is down a tick from February, and the labor force participation rate ticked up. So it's hard to find anything really negative. If you really want to try to find something that could be negative in this report, the manufacturing number came in a little bit weaker. February was revised down. The so-called diffusion index, which is sort of the manufacturing sectors expanding versus contracting, was sort of slightly negative. So a little bit more sub-industries there showing job losses than gains. But I mean, that's just one facet, relatively small facet in terms of employment for the broader economy, and just seeing really strong gains, for example, in the healthcare industry, in hospitality and leisure, which is of course sort of a cyclical sector. And so if you're sort of looking for things that would portend weakness going forward, it's a little bit hard to find those in this report. So, overall, just a really, sort of strong indication of what the economy is doing right now, as well as, sort of continued momentum. If we look at sort of a bit of a longer trend, so here the blue bars are the monthly changes in non-farm employment, and then the orange line is the moving average. We've actually, excuse me, seen a little bit of an uptick in the trend, right? So we were coming off the kind of COVID rebound in jobs. that was, sort of slowing down from a crazy pace of, averaging over 500,000 jobs a month down to something, in the 250,000 jobs. And then we sort of dipped below the 250,000 there towards the end of last year, second half of last year. But then the last few months have been ticking up so that the kind of 3-month moving average is actually accelerating at this point. So, what does this mean, for the economy broadly? What does it mean for monetary policy? Let me talk about the economy first, and then we'll kind of get into what it means for what the Fed's going to be doing. So, the cumulative job gains have just been really, really substantial. So of course, as I just mentioned, there was this really quick strong, quick rebound after COVID. But we're well past that range now, right? So we're in the like 6 million net jobs created, even after getting back to where we were prior to COVID. And that, again, that line is flattening out a little bit, but not much, right? So there's still just a lot of strength and momentum in kind of just the overall trend to what's happening in the labor market. And what does this mean in terms of economic growth? People were talking about recession last year. Doesn't sound like people are talking about recession much this year. You have to look at the unemployment rate, recently really, really closely to see anything that looks like a soft landing in the sense of, sort of a moderating unemployment rate. Long run average unemployment rate for the U.S. is around 5%. We're well below that. We've been under 4% for a couple years now. That has historically been a sign of quite a strong economy, even an overheating economy at times. And so I think the legitimate question on the table now is there a soft landing, right? Or are we still, racing along at supersonic speed in a way that, is potentially dangerous for inflationary pressures in the economy? So let's dig into that a little bit more. Overall economic growth has been quite strong. Last year, we saw economic growth that averaged more than 2%. The long run growth rate for the economy is in the sort of 2.5% range, depending on what historical horizon you look at. So we've been above that now for a couple quarters. So here, the blue bars are real gross domestic product. So that's inflation adjusted output. And the orange bars are gross domestic income. So these are kind of two sides of the same coin, but they don't track each other perfectly on a quarterly basis. But there had been some concern that income was lagging output. But most recently we've seen that bounce back. So we've seen strong numbers for both income and output, numbers that are well above the long run trend growth rate. And so again, you got to wonder if these are sustainable. This is data through the end of last year. If we think about what's happened in the first quarter, I mean, the first quarter is behind us, but we don't have a GDP estimate for it yet. We have sort of good guesses that come from different models. So a lot of people like to look at the Atlanta Fed's nowcasting model. Before the report today, it was forecasting about a 2.5% growth rate for the first quarter. I got to think that when we see the estimates that include the numbers from today, that'll be closer to a 3% growth rate. So then you're looking at 3 consecutive quarters of GDP growth that are sort of above trend. And we just have to wonder, is that a sustainable situation? And what are the risks on the upside to the economy overheating again? So want to kind of dig into what that might mean for inflation and what it might mean for Fed policy. So here's the latest inflation data. This is the core PCE deflator. So this is the Fed's preferred measure of inflation. It strips out food and energy prices. It's based on a consumption basket, so it's a little bit different than what the CPI has. The Fed thinks this is probably a better measure of inflation. And so, of course, we had this big jump in inflation. in 21, and things leveled off a bit in 22, and then started to come down in 23, and looked like we were really headed towards that 2% target. So here the blue bars are sort of 3-month annualized, the orange is 6-month annualized, and the green is a year over year. So the 3-month is going to be more volatile, but it's also going to be more timely. So yeah, so things were looking pretty good the end of last year, but you look at the most recent prints of these core inflation numbers, and it looks like there might even be some acceleration in inflation. Of course, the Fed digs into these in tremendous detail. They're going to look at every single subcomponent, and there's funny things that happen, with housing and mechanical lags in the data and stuff like that. And they're certainly aware of all of those things, but just sort of taking a high level view, we're not on that obvious trend towards disinflation or a deacceleration of the inflation rate anymore. We get more inflation data coming up in the next couple of weeks. So next week we get to the CPI, so that'll be informative, and we'll continue to look at pricing measures. But yeah, we're sort of potentially off that trend, and that's got to worry the Fed. So what's happening here from an economic standpoint that could be worrying in terms of overheating economy, additional pressure on the inflation side? Well, the savior of the economy has been the labor force growth. So the reason we've been able to, a couple of years ago, have job growth of 500,000 a month, and then, averaging close to 250,000 a month, is because people were coming into the labor force. Some people were coming back to the labor force after having left during COVID. You had new entrants to the labor force as well. But that's kind of stalled. So this is the civilian labor force in terms of the actual numbers here. So that number on the right over here is 167.5 million. And we've kind of been at that level now for a year or so. So while last month we had an uptick in the labor force, that isn't sort of part of a trend over the last year. And that's why the unemployment rate came down. It's why the unemployment rate is so low, because we've had very strong job gains, and then most recently, not a really strong trend in people entering the labor force. So why is that? Like, what's going on there? Again, it's in order to have the labor force grow faster than the population, you need people kind of coming off the sidelines and going to work or looking for jobs. And there was a big trend of people that had left the labor force during COVID, as I mentioned. That trend's over, right? I mean, there's like basically nobody that left the labor force during COVID has not come back. It's just a very small number there. And sort of aggregate. Of course, it's not exactly the same people, because some people retired and some people came into the labor force. But if we sort of look in aggregate, like what's the effect we might expect from people returning who in aggregate again left from COVID? It's done. Nobody else left to return there. So we got to find sort of more organic, traditional types of growth in the labor force. That's harder to do because it's going to come from immigration, it's going to come from demographics, and we know both of those are not places that we expect to get very strong growth in the labor force. And the market seems to be taking some similar view of this. If you look at what's happened, to expectations for Fed policy over the next year. This is the Fed Fund futures market expectation of what the Fed funds rate will be going forward. It's a Bloomberg grab. And so the green line is from a month ago. And you can see that, over the next year or so, people were expecting that the Fed funds rate would come down to about 4.25%. And then this is from a couple days ago, but that expectation of the Fed cutting rates is much more modest now than it was even a month ago. So looking at a Fed funds rate a year from now, it'd be like 4.5%, maybe even a little higher than that. And I've got to think is people are looking at today's employment report, there's got to be even more thought that, the Fed, maybe they're not going to cut 3 times, maybe they're going to cut twice, maybe they're only going to cut once, maybe they're not going to cut at all. If we continue to see strength like we've seen the last couple months or so in the economy and in the labor markets in particular, like that's got to give the Fed some pause as to whether inflationary pressures are really going to be reduced. So if we look at the 10-year Treasury rate, similar story. I was looking at how the Treasury market responded to the employment report, and it got a right uppercut to the jaw, so down about 20 ticks, so about 2/3 of a point, and the yield up about 10 basis points or so on the 10-year Treasury, and that's off of a already higher rate that we've seen basically since the beginning of the year. So expectations for longer term rates have definitely ticked up. So, we got all the way up to 5% for a variety of reasons last fall, late summer and fall. Rates, came down to under 4% by the end of the year. And now we're back up in the sort of 4.3 to 4.4% range. And yeah, I mean, it's interesting here. I guess, everybody was expecting rates to decline. And the funny thing about markets is when everybody expects something to happen, often the opposite happens because there's nobody left to bet against the thing that everybody expects to happen. So definitely some change in sentiment around what the Fed might do and what interest rate path is going to be over the rest of this year and next year. So what could change that? So, I don't know. Is a really strong economy good news or bad news? I guess it's kind of good news in the sense that, things are humming along and, wages, are strong. But we can't have an economy that's too strong, right? In the sense that, there are limits to economic growth. There is sort of a Goldilocks notion of what the right growth rate is. And if you get above that, the economy is too hot, it drives inflation, other bad things can happen. And so really you can think about what the Fed's job is, and I guess economic policy more broadly, is to try to bring economic growth to be in line with the potential for the economy to grow. And so there's, literally economists have the potential estimates of the potential growth rate for the economy. And you can think of this as a potential GDP. It's sort of like what supply is, aggregate supply. So this sort of tells you how much can the economy produce in terms of goods and services on a sort of a equilibrium basis. So it's sort of the Goldilocks target rate for growth. And so here the blue line I plotted actually in the level, not as a growth rate, but as a level in terms of billions of inflation adjusted dollars. That blue line is sort of the potential growth rate for the economy. And then the red line is the actual level of GDP. And so you can see, as we all know, there was a big dip in the economy around COVID. The economy sort of went well below potential. And then maybe those of you that are real Kenan Institute aficionados will remember that Gerald and I had a debate about kind of what was happening, in terms of potential. I was making the argument that I thought potential had actually dipped quite a bit and deviated from that blue line, because the labor force had declined quite a bit, and that was a risk to the economy. And I think Gerald will admit I had some good points to make at that time, and there was, that was sort of what was contributing to inflationary pressures. But then as the economy started to normalize, we kind of potential probably really did return to something like that blue line. But the economy has been so strong too that it's really been tracking that. And you can see that, that little bump of the red line above the blue line, that's when we really started to see really strong inflationary, pressures. The growth kind of moderated back towards that potential level. But then again, just towards the end of last year, and I think continuing into the first quarter of this year, we're seeing that red line deviate again from the potential growth rate. So this says that the sort of demand in the economy, which is the actual GDP, that's the red line, is deviating from supply in the economy. And that's just not something that's sustainable in the long run. You can do that for a quarter or two and not cause a problem necessarily. But if you have sustained demand that exceeds potential output of the economy, that's going to lead to inflationary pressures. That's demand exceeding supply. And we know that how the price mechanism works, that's inflation. So, how do we think about, potentially having an economy where we don't have an imbalance between supply and demand. One way is to have more workers, but I've already made the case that I don't think that's going to happen. We're not going to be able to see sustained growth in labor force of 300,000 people per month. So the other thing that determines potential output for the economy is productivity. So if the economy becomes much more productive, you can produce more goods and services. That keeps the economy from overheating, kind of brings supply back in line with demand. So what drives productivity? Well, first of all, let's say productivity has dipped. Kind of coming out of the COVID area, there was a big jump in productivity around COVID because we were inventing new ways of doing things, and the labor force had shrunk, but output was kind of hanging in there, especially in the 21 era. Then, as things started to normalize, we saw a decline in productivity, but most recently in 2023, we've actually seen a nice uptick in productivity. What drives productivity? One thing that drives productivity is investment, and it's been nice to see that investment has held up quite well in the U.S. So this is a measure of the percentage of GDP that is basically business CapEx spending. So technically, it's non-residential fixed investment, but it's fine to just think of it as CapEx for businesses. And that number, is historically been in like the 13% range, and we're a little bit above that average right now after a dip that we saw coming out of COVID. And so that's reassuring in some sense, because if businesses are making investment, that increases the productive capacity of the economy, increases productivity, that increases potential GDP, and supply comes back into balance with demand, and potentially alleviates inflationary pressures. But these are also kind of long run things, in the sense that investment often takes a while to put in place, takes a while to realize those gains. So business investment is something that realizes productivity gains over a horizon of a year or 2 years or 3 years typically. Maybe that's accelerated in some cases if people start, for example, making large investments in AI, and those pay off in terms of productivity gains quickly. Maybe that's faster than buying a new big machine tool or building a new plant, which would be other types of historical CapEx spending. But I think there's still a legitimate concern out there as to what's happening cyclically in the short run this year in terms of economic growth, and what that means for Fed policy, what it means for inflation, and something we got to continue to keep an eye on as we see these really barn burner employment reports. So I've been rattling on for a while. Stop there, and Rob, if there's folks that have questions, happy to entertain those at this point.
Thank you very much. Terrific analysis. A lot going on this morning, and appreciate you going in depth on that. I read a couple things this morning touching on immigration, which you touched on as well, as maybe being the secret sauce that has allowed this to happen. But again, that would fall into the category of things you can't necessarily depend on going forward to keep this steady growth going, right?
Yeah, I mean, there's sort of two facets to immigration. One is sort of the desired or planned immigration, where people are coming in on work visas and all that, and that's slowed down some. But there's evidence to suggest that undocumented immigration has been accelerating, right? And then those people are showing up in these labor force numbers or showing up in employment numbers in ways that are not well characterized by the data. And so, while we might think, okay, immigration policy is only going to get us, I don't know, 30,000, people a month or something, when we include undocumented workers in there, that increases it to 100,000 or something. And so from an economic standpoint, I mean, that's a way to relieve that labor shortage in some sense. Of course, it raises a host of other policy issues that, we probably don't want to dig into this morning. But maybe in the short run that's a help. In the long run, it'd be nice to have some sort of rational immigration policy, that we can dial up and dial down the way other countries do, based on what current labor market needs are.
Okay. Perfect introduction to the fact that Professor Tara Watson of Williams College will be with us this coming week to talk about
Mhm,
immigration and the economy. So we're looking
mhm.
forward to that here at the Institute. Information on that at kenaninstitute.unc.edu. Also, is the Fed looking at this, seeing this continued growth despite everything that's happened over the last, I guess, 39 straight months that we've had growth, and thinking, well, maybe if there is a tendency toward inflation, that we could go ahead and raise interest rates and we're not going to damage growth too much.
Yeah, I mean, honestly, I don't know what the Fed's thinking, because if I was a Fed governor, I'd be much more cautious than it seems like the typical Fed governor is being right now, and Jay Powell as well. I mean, they're walking it back a little bit in terms of what rate cut expectations are this year, but it still seems like the consensus is for easing. And I mean, I'll tell you, I'm not like a diehard monetary hawk, but it does. I mean, I would be like, oh yeah, I don't know if we're going to cut rates this year, based on what we're seeing right now. I mean, clearly there was a rapid increase in rates that did have some slowing. It dislocated some sectors, potentially real estate, parts of real estate, and but it overall has not had a significant effect on output growth, GDP growth, or employment, right? I mean,
Hmm.
since the Fed started raising rates, we've continued to see very strong labor markets and very strong GDP growth.
Okay, thanks. Uh, from an attendee, wouldn't increased business investment in fixed structures from the CHIPS Act for higher GDP? This would increase supply without necessarily producing demand pressures.
Yeah. Yeah, and I think there's certainly high demand for chips right now, and a strong desire to have more of that production happen in the U.S. That would increase GDP because I mean, let's say just demand is really strong. Period. You're going to be substituting away from